This video is about accounting principles, third chapter of class 11th accounting. The very first thing I would like to discuss why accounting principles are needed. So I would like to tell you that accounting principles are also known as gaps. Now what are gaps? Gaps, the full form of gaps is generally accepted accounting principles. Now the question arises, why gaps are needed? What is the use of gaps? Why it is required? So the answer is, we know that accounting serves as a language for the business. Why it is a language? Because through accounting we communicate the results of the business to all the interested users. So accounting serves as a language of the business, and we know that every language have its own grammar. So accounting must also have its own grammar, which helps to create financial statements and all other accounting recording of all other accounting transactions. So in this way, when every language needs a grammar, accounting also needs some grammar or rules. So accounting principles are served as a grammar or rule of accounting. So that's why they are needed. The next point is, what do you mean by accounting principles? Now, what are accounting principles? Actually, accounting principles are guidelines, they are boundaries within which accounting has to be done. Accounting principles helps us in preparing of financial statements of the business. Now, the next topic is nature of accounting principle. If we talk about nature of accounting principle, the nature of accounting principle can be explained with three major points. The first one is accounting principles are man-made. What does it mean accounting principles are man-made? It means that accounting principles are not the physical science principle. They are derived from experience and they can be recommended to use for uniformity in accounting. The next point is flexible. What does it mean? That accounting principles are not static and they can be changed as per the situation and time. The third point is generally acceptability. What does it mean? General acceptability means that accounting principles will be accepted when they fulfill the three conditions. The first one is relevance, the second one is objective, and the third one is feasibility. Relevance means that accounting principles should be relevant. Accounting principle will be relevant only when they are helpful in providing such an information which is useful to the business. The second point is objective. It means that accounting principle will be generally accepted if they are not affected by personal bias, or you can say the personal decision of anyone. The third point is feasible. It means that accounting principles should be applied without any extra cost or undue cost. If any principle serve these 3 points, then it will be generally accepted. Now we are coming to the next topic, and that is types of accounting principle. If we speak about types of accounting principle, it can be divided into two parts: concepts and conventions. Now, accounting concepts and accounting conventions. What are accounting concepts and what are accounting conventions? If we talk about accounting concepts are fundamental assumptions which helps us in preparing financial statements and which also helps us in recording the transactions. Without following accounting concepts, since these are the basic accounting concepts, basic assumptions, so without following these assumptions, transactions cannot be recorded and financial statements cannot be prepared, and if they are followed, they will be helpful to make the financial statement understand in an easy form. Now the next point is conventions. If we talk about conventions are developed through a period of time by experimenting accountings. So conventions can also be changed as per the situation, and conventions may undergo with the change as per the time period and also can go under the improvement. So conventions can be changed for improving the providing accounting information. Now let us discuss about different types of accounting concepts. As I told you that accounting concepts are the basic fundamental concepts of accounting which can never be changed. The first accounting concept is going concern concept or going concern assumption. Now what does it mean going concern? The word going concern itself says that something going and going on, and no one can decide or foresee the time when the business, a profitable business, a profitable running business is going to be shut down. So no one can foresee the time, the date when a profitable business will going to be shut down. So this concept says that accounting of any business firm should be done taking in mind this point that no one can foresee the date when when the firm is going to be closed down. So what is the effect of this on accounting? When we cannot decide when we are going to close the firm, it means that we will presume that business will go on for an unforeseeable time in future. When we think that business will go on for an unforeseeable time in future, certainly our expenses can be classified into two parts: expenses which are for short term and expenses which are for long term. Similarly, incomes can also be divided, or receipts can also be divided for short term and long term. And these short term and long term or regular and irregular expenditures and receipts can be named as capital items and revenue items. Revenue items are those items which are for a short period, for 1 year, and capital items are those items which are for long period. So because of this principle, going concern principle, outside parties enter into a contract with the firm. Think about a firm which is going to be closed. Do you think that any outside party will come into contract with that firm? Certainly no. So that's why it is assumed that business will undergo for an unforeseeable time in future. Because of this concept only, if we pay something in advance, we treat that expense as a prepaid expense and write in our balance sheet as an asset. So this is about going concern concept. The next concept of accounting is consistency. What is consistency? Consistency means that whatever rules are followed, that should be followed year after year. Means if there are two methods of treatment of any particular item in accounting, and if the firm is following any one particular method out of that, the firm should continue with the same method. However, if the accountant feels that change in the method will helpful to give better information to the users, then certainly the method can be changed. However, the method of accounting should not be changed year after year. It should be changed and its effect must be disclosed along with the financial statements. So consistency concept says that accounting practices once selected should be applied consistently year after year. It should not be changed year after year. And if there are two methods and if the accountant feels that one particular method is better than the other, then certainly the method can be changed. But if it is once changed, it cannot be changed again and again. The next concept is accrual concept. Accrual concept means that accrual concept means that any transaction or event which are incurred, expenses are incurred, or revenues are going to be received should be recorded in the business. What does it mean? That if particular expenditure is made in a particular year and the full amount is not yet paid, the unpaid amount of that particular year should be taken as an expense. Similarly, any unpaid income should be taken as an unreceived income should be taken as an income for that particular year. Because if we do not record such unpaid expenses and accrued incomes, the true profit or loss can never be calculated. Now we are coming to the topic conventions. Conventions means, as I earlier discussed, that conventions can go under change for improvement. Right now we are having 11 conventions to be discussed in accounting. The first convention is business entity concept or business entity convention. What does it mean, business entity? Business entity means that a business and the owner of the business and all other stakeholders, like you can say the creditors, those who have given loan to the firm, or suppliers, or buyers of the business, those who are purchasing goods from the business, all are separate. What does it mean? That business firm should be taken as a separate entity from its owners and other stakeholders. This convention is very important. Without following this convention, no business firm can calculate its correct profit. Suppose you are running a restaurant and you are daily enjoying a dinner party with your friends in the restaurant. If you are not properly recording these dinner parties as a drawings, then how will you be able to calculate the correct profit of the business? Similarly, if you have two different businesses, a restaurant and a transport company, if you do not have separate records of these two businesses, how will you be able to calculate that which business is running in profit and which business is loss, or which business is going on in high profits and which business is going on in moderate profits? So without having a separate entity convention, we are not be able to calculate correct profit or loss. Because of this concept, capital is treated as a liability for the business, and it is assumed that business has borrowed money from his owner rather than outsiders. Because of this concept only, interest on capital is allowed. Because of this concept only, any amount of goods or cash withdrawn from the business by the owner for personal use are treated as drawings, and interest is charged on drawings. Coming to the next convention, money measurement. What is money measurement? In accounting, we record all the transactions in the monetary form. We cannot record that the business firm have 10 trucks, 20 bighas of land. No, we will convert these things into money, because money is the only common unit through which we can add or subtract all the things and find out the correct profit and correct financial position of the business. The third convention is accounting period. Accounting period means that the life of the business, as we discussed earlier in going concern, that life of the business is unforeseeable in future. So if we wait to know the correct profit for such an indefinite period, certainly we will not be able to calculate the correct profit. And also, if we are having some mistakes in the business, like we are spending more in some particular item, we will not be able to curtail such mistakes. So it is decided that profits or losses of the business will be calculated after 12 months, and these 12 months are known as accounting period. Or we can say the life of the business is divided into small parts, and that small part is 12 months, and it is known as accounting period. And after completion of each accounting period, we calculate profit or loss and financial position of the business. The next convention is full disclosure. Full disclosure means that accounting should be done in such a manner Financial statements should be prepared in such a way that no important information should be hidden. Everything which is important for the users of the accounting must be disclosed. However, full disclosure doesn't mean that disclosing the secrets of the business, but any important information that is useful for the users must be disclosed. For example, disclosure of contingent liabilities. Contingent liabilities means a liability which is not a liability right now but may become actual liability in future on happening of a certain event. For example, if there is a case against the firm in the law court, the firm may win the case, the firm may lose the case. If the firm loses the case and the decision of the court goes against the firm has to pay. Such liabilities are known as contingent liabilities and must be disclosed. The next convention is materiality. Materiality convention says that any information which is of less use or not at all useful for the users should be either merged with other item or should not be disclosed. So we can say that materiality and full disclosure are opposite. Full disclosure says we must disclose all the things, while materiality says we should ignore immaterial items. Materiality depends upon business to business and firm to firm. For example, for a small roadside motor workshop, small tools of 500,000 rupees are material, but the same tools are less important for a workshop in Maruti or Tata Motors. Materiality also depends upon the nature of transaction. Rupees 500 difference in cash is material, but rupees 500 difference in the spare parts or in the store of the firm is less material. The next point is prudence. The principle prudence says that we should record the transactions in such a manner that we should ignore all expected gains, but we should record all expected losses. For example, suppose the closing stock of your business is valued at rupees 20,000 as per your cost, but the market price is 18,000. So you should not record 20,000, you should record the value of the closing stock is 18,000. The reason behind it, if you record 20,000, it means you are recording expected gains in your books, and this is against the principle of prudence. The next principle is cost or historical cost. The cost or historical cost principle says that all the fixed assets of the firm like land, building, plant, machinery, all tangible assets should be recorded in the business at their cost price rather than their market price. The reason behind is that market price is fluctuating and difficult to trade. It is very difficult to trace the market price because market price cannot be static. It will be dynamic and will be changed according to the demand and supply forces in the market. So we should record the price of fixed assets at their cost price less depreciation. The next principle is matching principle. Matching principle says that all the expenses of the one accounting period, I hope you remember accounting period, 12 months accounting period from 1st April to 31st March, we discussed earlier. So all expenses related to one accounting period should be matched with the receipts of the same accounting period. In this way, we can easily calculate the net profit or net loss. While recording all the expenses for the one accounting period, all expenses which have not yet paid should be taken into account, and any expenses which is paid in advance for the next accounting period should be deducted. Similarly, all receipts which are for the same accounting period must be added whether received or not, and if any income is received in advance should be deducted. 12 aspect principle says that every transaction affects at least two accounts. One account is debited and other is credited. This principle is helpful in understanding the accounting equation or the balance sheet. In balance sheet, all assets are always equal to our liabilities and capital. The next principle is revenue recognition concept. This principle says that any amount which is not yet realized but related to the current accounting period must be taken into consideration. So revenue should be considered have been realized when a transaction has been taken place and not on the basis of when cash is received. The next principle is verifiability. The verifiable objective principle or convention says that all accounting transactions must be supported by the supporting documents like vouchers, cash memos, invoices, etc., so that we can have proper auditing of the accounts. Thank you.